Bitcoin bounces 10% as ETF inflows just keep on coming. Cool skew comes back as investors chase the upside. And Ethereum dealer Gamma explodes, meaning underperformance may be more likely for ETH. All this and more in this week's Crypto Options Unplugged. Hi everyone, welcome back to Crypto Options Unplugged. I'm Imran Larker from Options Insight, and again I'm joined by my friend Dave Brickell from FR&T Financial. Dave, you nailed it. We got a squeeze.
We got the squeeze. What a difference a week makes in crypto, huh?
Amazing.
Yeah, I mean, it felt last week. You know, everyone was talking about this 35k. I think we mentioned, you know, when everyone's talking about 35k, probably bottom around 38, and we probably weren't far off of that.
Although it was like there for 2 seconds, and you didn't get any hedges off.
Yeah,
right?
exactly, and yeah, a super nice rally over the last week. So yeah, feels like crypto feels a good place again.
So anything moved materially on the macro stuff?
No, I mean we're like obviously we're very much in this Goldilocks world at the moment, where you know equities are just ripping and making ever new record highs. Last week, kind of fueling that Goldilocks, we had the Q4 GDP print for the US, came in at 3.3%.
That was a blowout, right?
Blowout, yeah. I think consensus was 2%. But then the flip to that was it's not feeding into inflation, so inflation continues to come lower. I think core PCE for that quarter was at 2%. And actually, if you look at 3-month annualized core PCE, it's now at 1.5%.
Yeah, it's undershooting their target.
It's undershooting, yeah. And I actually think there's a risk that we do materially undershoot the Fed target this year. So as far as the Fed are concerned, you know, they'll still be pretty comfortable in thinking about these rate cuts. And obviously as inflation comes lower, then real rates are becoming more restrictive. So that's giving the Fed all the cover they need to actually cut rates. And I keep hearing people talk about, you know, because of the resilience of the US data, you know, why would the Fed cut now? Why would they need to cut? But real rates are getting increasingly restrictive. And so given this dynamic with inflation continues to come lower, you know, the Fed now have, in my view, plenty of room to cut. And I actually think we will see the March rate cuts, even though the market's now pricing less than 50% for that. By the time this airs, I guess we would have had the Fed potentially, and so we'll know a little bit more then.
What about the QRA? Because that market liked the QRA yesterday, right?
Yeah. So
for those who don't know, that's the quarterly refunding announcement where the Treasury say how much they're going to raise in terms of debt issuance.
Yeah. So what we saw last night, which caused the bond rally, was their forecast for borrowing for this quarter was about 55 billion less than what they originally thought. Now, cynically, I kind of think it would suit them right now to lowball that one in terms of their forecasts. But again, what we'll get on Wednesday, so probably maybe by the time this airs, we'll actually know how they're going to finance that. So the mix between longer term bonds, shorter date bonds. So my expectation is they'll continue to skew that towards the shorter dated bonds, so that they'll keep draining this RRP that we've spoken about, where we've got cash sat there overnight with the Fed. Keep taking that out to finance this government debt via T-bills. Now, what's really important, and why I keep talking about, you know, the Fed have got cover to cut. They need this cover because this debt sustainability is becoming an issue, and we kind of at this inflection point now with US debt, where you know we're looking at debt interest costs, just interest costs being $1 trillion annualized. So like this is massive, and it's kind of spiraling, and for that reason, I think the Fed realised they need to get rates lower to kind of alleviate some of that pressure on the US government debt. So I kind of
QT. QT is a big story, right? So are they going to stop QT? Are they going to have to, because there'll be no money to soak up the issuance? I think a lot of people have been talking about that recently.
Yeah, well, so the Fed themselves have started to float the idea that they'll taper QT as the RRP approaches zero. So I've been talking about this for a while. So I imagine as on the QRA, this refinancing announcement, it'll again be more skewed towards T-bills, which we'll know will continue to drain the RRP. I think that'll be drained by March. So I think the Fed are going to have to start really laying the groundwork to taper QT in line with that sort of approach to zero on the RRP. So I think they're going to lay the groundwork for that, which I think the market will perceive as a dovish like development.
Isn't the market kind of expecting that now?
I think so, but again, hearing it, you know, and then how does that kind of tie in with, right? We're gonna start ending this kind of balance sheet reduction. You know, how does that then tie in with what your kind of broader view on policy is? It kind of just leans into this like easier policy world where they'll then also look to cut rates. I actually think bigger than that, it starts to they'll have to do QE at some point or some version of it. So like because you know, we're back to this world where it's just not sustainable on its own. And the Fed are ultimately the buyers of last resort for this debt. So I kind of think we're going into this world where they were thinking about, you know, inflation. That was all anyone wanted to talk about. Now they've got inflation kind of under control. They now need to start thinking about the liquidity issues and how they're going to get ahead of that. And I think inflation now being contained and in my view will probably undershoot gives them that option now to right now we can focus on trying to get ahead of some of these liquidity issues that are building. The other big issue, so we've talked about government debt, which is going to be an ongoing problem. The other issue we've got is in the banks. So we've still got banks that are massively underwater on their government bond holdings, and we saw obviously last year the regional banks particularly. Obviously, we saw a few blow-ups with SVB and a few others. And we had this deposit flight out of the banks, everyone basically seeking higher yields, leaving the banks. So the Fed introduced this BTFP, Bank Term Funding Program, where essentially so the banks that had to sell their treasuries to basically find the liquidity to match the deposit outflow, these treasuries were underwater. So basically they were looking at an insolvency crisis.
Because they would lock in a loss on those treasuries if they sold them, right?
Exactly. So this BTFP said, right, we'll lend you the money so you don't have to sell those. And not only will we lend you them against the bonds as collateral, we'll lend to you at par.
Oh, yeah.
So more than what they're actually, the mark-to-market value of these bonds are.
When their par's at 100, but they're trading at 80, you can borrow 100 against something that's worth 80.
Yeah.
Basically.
So it's kind of a huge...
I wish they'd let us do that.
I know, right? Yeah.
Individuals.
Yeah, it's like one rule for them.
Yeah.
In a way, I guess an important sort of part of last week was, so they've announced that was due to end in March. They've announced that program will end in March. Now, what does that mean? Arthur Hayes, I don't know if you read his piece.
Yeah, I follow his
stuff.
Like,
really good piece. I mean, he
thinks the world blows up on that one.
He thinks the world blows up, and we get this kind of treasury blow up because immediately the banks are going to then need to find the liquidity from somewhere else, and then it'll be about selling their bonds, which then again is kind of going to put pressure for yields to go higher as bonds come lower, and then potentially more solvency issues in the banks. Where I'm a lot more relaxed around that is these loans are 1 year loans. So they've essentially got till the 11th of March to take these loans out. So then we'll see them mature over the course of a year. So the problem's kind of brewing, but over the course of a year. And again, for me, the fact that the Fed have said we're going to end this program tells me that they see themselves engineering a lower rate environment, which will then alleviate the pressure on these banks and the balance sheet pressure on these banks.
Yeah, because they saw how quickly the banks melted down, right? I mean, it wasn't like there was a lead time. Like I was trading in 2008 and the Lehman's crisis, etc.
Yeah.
And there was like a good year from where the credit market was showing signs of stress to when Lehman's actually went down. But these regional banks went from fine in January, February to like going bust in March, it seemed, right?
Yeah.
So the speed at which this stuff can happen, the Fed have seen it, they're aware of it. So if they haven't got a backup plan, it would be a bit crazy to pull that facility away, right?
And all of this, like to your point, the whole financial system is basically hung together on confidence. Right, so as soon as you lose that confidence in the banking sector, you start to see bank runs, and then all of a sudden they're forced to find liquidity and sell the assets that are underwater to match the sort of liquidity mismatch. Government debt, right? We saw in parts of last year people start to question the sustainability of government debt. And then all of a sudden yields are spiking and no one wants the bonds. And I think they're really aware of that. And I think this is what I talk about, having the cover. Inflation's given them the cover to start getting ahead of those issues and just quietly kind of smooth out some liquidity issues without it being an emergency type bailout.
Yeah, like panic wants be reactive rather than be sort of preemptive.
Yeah,
right.
Exactly.
Yeah.
So my big point when it comes to the Fed is, the Fed are not just about the economy. They're not just about inflation and employment. Their number one role, I would say, is liquidity provision to markets.
And financial stability.
Yeah. That's their number one role. And particularly is providing sufficient liquidity to essentially artificially inflate the assets that underpin this whole system. Right? That is their number one role. But we're coming to kind of the window to normalize, both through hiking rates and for reducing the balance sheet, is a very small one. And we come into the end of that period where they've been able to do that. And that window is closing rapidly on the Fed. And I think they're aware of that. Hence, they're talking about the rate cuts. And they know that their window for normalising the balance sheet has run its course. Because at the end of the day, for any kind of growth, it's dependent on debt. And essentially, the Fed are going to need to provide the conditions for continued debt expansion, and you can't have that in higher rates, and you can't be draining liquidity out of the system. So I think, part of my bullishness for Bitcoin, and maybe Bitcoin's still picking up on this, is that...
Well, I was going to ask you, we've talked a lot about the macro. How does it relate to crypto? And what should crypto investors be taking from that? Yeah,
so again, it feeds into, crypto is a liquidity junkie, and it's a hedge against the failure of the fiat system. And again, this is a moment that we're moving into where that, for me, becomes quite obvious that the fiat system is not able to stand on its own 2 feet. It needs the Fed to be cutting rates, and it needs liquidity. It constantly needs liquidity. So Bitcoin particularly is the hedge against that fiat currency debasement. It's the hedge against what I'd call monetary inflation. So people will question, if Bitcoin's performed the inflation hedge, given the sell-off we had in 2022 when inflation was kind of out of control. But I actually think its bigger role is hedging against this monetary inflation, this balance sheet expansion, and the resulting currency debasement.
Yeah, because exactly, because it's not if you got goods price inflation, and then because of that you get kind of public discontent, then there's political pressure on the central bank to hike rates and control that headline inflation. And in a world where they're hiking rates, you're effectively tightening monetary policy. So that's the opposite of currency debasement, right? So currency debasement assets like Bitcoin aren't going to do well in a monetary tightening that we saw in 21, right? But now what you're saying is it's kind of this, now we're going back to looser policy. That's what Bitcoin allows you to benefit from, because in that looser policy world, you're debasing currency again. You've got more asset price inflation rather than headline CPI inflation from goods and services. And that's the thing that Bitcoin's protecting you for, right?
Exactly. And I wrote in the newsletter that I write, London Crypto Club's Connecting the Dots, basically prepare for an explosion of liquidity. And you're seeing it in China, by the way. China, again, are really having to react to...
Oh, well, we talked about China last week. So what's been the movement on China?
Again, so they cut rates. They cut the reserve requirement ratio by 50 bips.
Biggest cut since 21, that was, right?
Exactly right. So they continue with liquidity injections. We've had the property company Evergrande officially liquidated. That's kind of not a surprise, but all these things are reaching ahead, and the ultimate answer to it will be this injection of liquidity. It's coming from China. I think we're seeing it now in the US as they reach that end game as well. So I think this year, again, we're in for this explosion of liquidity, which for me means Bitcoin is going to make new record highs. You're seeing it in the Nasdaq, you're seeing it in the S&P, and I just think Bitcoin and the crypto space is set to follow this year.
And And is it Bitcoin again that leads the way, or do we, because we've been talking about, obviously the initial reaction to the ETF launch was actually everyone switching straight into ETH.
Yep.
ETH rallied 25% relative to Bitcoin in a heartbeat, but it's given about half or maybe more than half of that back, about 60% of that back. So is the ETH story done for now, or do we still like ETH for the rest of the year, or do we even prefer things like Solana?
Yeah, so I think as we go into, where it becomes about liquidity, then what you tend to find is Bitcoin leads, and then we kind of go what I like to say, we go out of the risk curve, so through ETH and then to like all the lower cap alts. So I think the alt space will outperform over the course of the year, which means in my mind ETH will outperform Bitcoin. I also think ETH's going to have its story with the ETFs as well. So as we come into that, I think ETH is going to really kind of outperform Bitcoin. Right now, again, we're just kind of Bitcoin's just taking the lead back, and as we start to, it becomes like almost like the safe haven trade when we start to hedge against the fiat system potentially blowing up, and then as the liquidity comes in, then you start to see ETH outperform and the other alts. A lot of hype and excitement around Solana at the moment, but I still kind of think with the ETH ETF, and I think ETH is just under-owned at the moment. Solana's had a lot of hype. I think we'll actually see ETH start to sort of come back.
Well, this is a question I also want the viewers to answer, right? So make sure you put your answers in the comments section. Do you think ETH outperforms or Bitcoin this year? Dave seems to think ETH is still strong. I kind of agree with him on a long-term view, but some of the things I'm seeing in the options market are telling me maybe ETH's going to struggle in the near term. So on that point, why don't we jump in, see what I saw in options this week? Okay, so jumping into what BTC realized vol has been up to over the last week. Since that big drop about a week ago, we were consolidating. We have had some decent upside, 4% plus rally there, about a 3% rally yesterday. So you can see this green line's kind of been hovering around the 40% level. That's where realized vol has been on BTC, but clearly we have bounced strongly off that 38k support zone. All right, now looking at the flows that we've seen in the market, you can see here that we saw some put sellers, June put sellers, and other maturities too, but people generally underwriting, happy to kind of sell puts, taking some premium as the market came lower. We've actually had some decent sized call buying in March as well on the 50k strikes and on the 75k strikes. And then an interesting vol trade was put on where a client bought the 41k straddle in April and sold a February strangle against that. So the idea being there, they want to own the volatility in the bucket that contains the halving, which is the end of April expiry, but they want to finance that by selling something that's going to earn them some time decay in the meantime, as the market kind of chops around, but net doesn't break too far. And that kind of helps. If you see the impact that's had on the term structure, it kind of explains as well why we've seen the front end expiries coming down. The weekly, obviously, gamma sellers coming out, selling very short dated optionality. But as we go out to that April expiry and beyond, is holding up much better there. And you can see that forward volatility, that's that term structure. What that's telling us is they don't really want to sell this longer dated stuff as much. They're happy to sell the front end because that's what's going to earn them some time decay, and it doesn't capture the potential event that might come from the halving. Now, looking at Ethereum, the main flows, big clips that we saw some bullish risk reversals trading, 2350 calls being bought to sell the 2100 puts. That's in middle of February expiry. We also saw a put spread buyer on 23rd of February as well, but people generally buying that 23,400 area in these big block trades. Upside trading in March and June as well via calls and call spreads. That's this stuff over here. But we had a lot of activity on the 24 calls. The 2,400 calls in Ethereum, the open interest changed by about 140,000 lots. And that's actually mainly coming from on-screen flow. We've got a lot of gamma selling activity coming in there. So all of these strikes, these purple bars, even though we may have seen some buyers on the block trade side of things, in terms of what was going on screen, it was very much gamma selling. And that was also putting pressure on the Ethereum front end of the curve as dealers were getting particularly long gamma. And we show that here on this chart. Something we track pretty closely is dealer positioning in gamma. Kind of gives us a feel for what the gamma hedging activity might be on cryptos and if it's going to have an impact in terms of vol suppressing or exaggerating. And we've seen this steady up move in Ethereum gamma positioning, and that is coming from all these calls that are being sold to market makers. And this is about as much as we've seen in terms of positive gamma in Ethereum since, say, last November. And certainly last year, when dealers were getting hit in lots and lots of Ethereum gamma, it was making it hard for markets to move. And this makes us think that maybe on the upside, if Bitcoin continues to rally in the near term, Ethereum might actually struggle to keep pace with that because of all the gamma in the market. Looking at skew, crypto skews really taking a turn towards calls this week. Obviously, Bitcoin sentiment turning a bit more bullish. And we can see we were in put territory for both Ethereum and Bitcoin, collapsing into calls, looking about 1 to 2 vol points call premium across the curve in both assets. But, we've talked about this before. The skew in crypto is very volatile. It doesn't have like a structural bid or offer that just keeps coming. It tends to be a bit skittish and a bit sort of chasing whichever way the market goes. And we definitely saw that with markets rallying where call skew has suddenly come back into fashion. And then closing it out, we look at the relative value side of things. The curve is pretty flat at around 0, which means Ethereum vol and Bitcoin vol are trading pretty much equal. If we go to the far long end, we have got a very small premium coming back on Ethereum. But in general, relative to what the realized vol's doing, we've got 10-day realized at about 8. We've got 30-day realized at about 3. So Ethereum has had higher realized up till now, but the market is not willing to pay for that. And therefore, they're offering Ethereum vol at the same price as Bitcoin vol because they're anticipating potentially that Ethereum might struggle to realize going forward because of all the gamma that's been sold to Ethereum dealers. So we're definitely seeing Ethereum vol at a discount to what's happened in the past, but we think the implied vol is probably leading and probably telling us that in a rally, particularly in the next month, Ethereum's going to struggle to realize as much as Bitcoin. On the way down, we actually think Ethereum probably realizes pretty well, but on the way up, it looks like some of this positioning could get a bit sticky, and that's something you definitely want to watch out for. All right, that's it for today's vol update. Okay, so that was what I saw. Key takeaways in vol space were calendar buyers kind of homing in on that halving bucket in April on Bitcoin, some decent chunks of upside being bought in March, and Ethereum just getting flooded in short-dated February gamma, which the dealers are now all sitting long, which I personally believe is going to make it very hard for Ethereum to break through that 2400 area, even if Bitcoin rallies. Don't forget, like and subscribe so that we can get this video out to as many people, we can educate as many people about crypto, macro, and options. But now, Dave, any thoughts on those option flows?
Yeah, I guess Bitcoin's kind of as we'd expect. Probably market was a little bit too positioned for the downside last week and now flipping that positioning and probably feeling a little bit naked on the top side and scrambling. I guess the ETH stuff's interesting in that it's probably frustrating my more bullish ETH view. So,
you might still be right, but I just think based on what I see in equities and the way when there's a large gamma concentration that the street's sitting on, it does become a bit self-fulfilling and it makes it hard for the market to go through those strikes. But bear in mind, the option market in equities is much bigger than it is in crypto.
Yeah.
So if there's a real reason to buy ETH and someone comes in and buys a lot of it, then it's just going to go, right?
Yeah, and this is something I talk about, particularly in relation to ETH, because we have this, these kind of call overwriters, and we've spoken before about, you stake your ETH and then you write some optionality against it for that.
Double up your yield, basically.
Exactly,
right?
yeah. So additional yield premium. When you have that kind of dynamic, then in the absence of a narrative that can really drive what I call like real flows, like real buying, then you kind of just always vol's gonna keep drifting lower, and then it probably will suppress the relative performance of ETH compared to Bitcoin and maybe others. And then price becomes narrative pretty quickly, right? So then all of a sudden, all the ETH haters, the Bitcoin maxis come out and just say, ETH's a load of rubbish, and this is why it's not going anywhere, and the SEC are going to call it a security, and all this stuff. But probably that's what provides the opportunity, right? If it's what I would call artificially suppressed, right? Because if we look at it from a more fundamental idea and what we've spoken about, if we start to, liquidity comes in, we start to move further along the risk curve, then you should start to see that outperformance. So it probably provides a really good opportunity to get long ETH. The problem, I guess, particularly from an option side of things, is timing that, right?
Yeah. What maturity?
Yeah. What maturity?
Yeah.
How do you play it? Do you keep short the front end, and then just hold some, I don't know, like where do you try and pin that around December and just hold some?
Yeah. No, that's a good question. I mean, I've gone to June because I think June's long enough. In a couple of months, maybe June won't be long enough. But right here, right now, June's long enough that it gives you some leverage to that top ETH move if and when it does kick in. Because if you go out to December, the kind of strikes you need to be picking are miles away if you want to go for low delta stuff. And I do think you want to go for low delta stuff just because if we did get a 10% outperformance on Bitcoin in the next month and you go for like 30, 40 delta stuff, it's going to sting you, it's going to hurt, and you're going to feel like cutting the position. Whereas if you go June 10 delta calls, own ETH, sell Bitcoin, which is a trade that I did recently actually, then that's not going to do you too much damage in a short-term Bitcoin outperformance.
Yeah.
But in a medium-term ETH outperformance of 30 to 40%, which is kind of what we're playing for, that's going to make some good money, right?
Yeah.
So, and if you were really nervous about it in the near term, but you wanted to lock in those cheap vol levels on ETH, you could do the opposite trade in the 1 month, right? Because the whole curve, as I showed on screen, the whole curve is pretty flat around zero for ETH Bitcoin vol spread. So you could own it in the 6 month bucket, long ETH, short Bitcoin, but then you neutralize your delta by doing the opposite trade in the 1 month bucket.
Yeah.
And that way you've locked in the cheap vol spread, but you haven't got any delta right here until the 1 month expires, and then you'll kick into your delta, right?
And I think thematically that makes sense in that I think the next few weeks are going to be about two things, right? I think the macro is going to start to play an important role because we'll all be talking about quarterly refinancing announcements and how the Fed are doing that. I think we will be talking more about this QT taper, this Fed tapering, the balance sheet reduction. So I think they're going to be bigger parts, bigger stories over the next sort of couple of weeks. And then the other big story, which we've not really even spoke about, is going to be with the whole focus on the ETFs. It's been like this grayscale selling versus the inflows into the nines. We're now starting to see, which is really interesting, we're now starting to see the grayscale selling start to slow, whilst the inflows into the ETFs are picking up.
Yeah,
so,
BlackRock hit 2 billion now, I think.
Yeah, right.
Yeah.
So we're that narrative starting to shift, and you would imagine, like starts to gather momentum in terms of the grayscale flows will kind of almost slow to a halt, whilst the inflows into the new ETFs will hopefully sustain the momentum, and then all of a sudden the flow dynamics completely change. So I think short term Bitcoin's going to get both more focus given the ETF stuff, as well as have the macro story again, as we talk about, the need to monetize debt and the liquidity coming in. So short term, I do think Bitcoin.
So you agree with me now?
Bitcoin, yeah, can have that. Yeah. Given the suppression on the front end, I think it's, again, timing these things is always difficult. Eventually then we can start to rotate back to a story, a more idiosyncratic story around Ethereum that can then start to overpower the more what I call mechanical selling of vol and everything that's just going to suppress vol and price for Ethereum.
Mm-hmm. Well, there you go. I managed to convince Dave. Question is, have I convinced you? Do you think the ETH narrative is dead for now? Do you think Bitcoin leads the rally like we do for maybe the next month? We still love ETH longer term, but it does seem like some of this option position is going to be quite hard to break through. All right, that's it for today's Crypto Options Unplugged. We'll catch you all next week.